let's go ahead and use the client that I have that is a law firm in Chicago, and they're doing $30 million. Okay. We approach them and we identify their risk, and there's probably 10 to 15 line items of risk right now that they have operationally on top of what? Their workers' comp and GL, and maybe their auto fleet. And those look like this risk where they're underinsured, business interruption. I mean, maybe COVID knocks them back by $500,000 a year. They're underinsured on loss of key talent, like a key man policy. They're underinsured on loss of key contract, loss of vendor, loss of supplier. How about brand risk? How about reputational risk? How about regulatory risk? So all these areas where they are underinsured, a third-party licensed actuary comes in and looks at this law firm against his industry and said, hey, you're underinsured in these 15 areas. Those risks identified and validated by the third-party actuary, who's using actuarial science, becomes their policy. And now they're self-adjudicating their risk on top of their P&C. So for that company, Greg, doing $30 million, they can now remit premium $3 million, 10% of their top line revenue, $3 million off their P&L as what? A business expense called insurance premium. So let's say in 3 years with investments, now they've got $10 million and a new bucket of money called Go Bulls Re, because they love the Chicago Bulls. So now they have their own insurance company, and they become their own bank anecdotally with investments and loans using what? A new stack of money called insurance premium.